On Wednesday, the Federal Reserve announced that they will maintain short-term interest rates at their present level. This is the third consecutive month in which they have decided to leave the federal funds rate, the interest rate for overnight borrowing between banks, as is. This was interpreted by many observers that the Fed believes that it is winning the struggle against inflation. They will leave interest rates unchanged in a range between 5.25% to 5.5%. This is the highest level in 22 years. Following the release of the Fed's decision, the Dow Jones Industrial Average jumped more than 400 points, surpassing 37,000 for the first time. In a span of just 16 months, short-term interest rates surged from near zero to above 5%. That was the fastest pace of tightening since the 1980s. While inflation has cooled considerably in recent months, the Consumer Price Index for October showed inflation up 3.24% compared with the same time a year ago, according to the most recent Labor Department data. Even with the recent moderation of inflation, Americans continue to pay more for necessities such as food, medical care, and rent. Markets had widely anticipated the decision to stay put as they did. That will end a cycle that has seen 11 rate hikes, pushing the Fed funds rate to its highest level in more than 22 years. The next question, of course, is how ambitious the FOMC will be regarding policy easing in the future. After their meeting, the Federal Open Market Committee issued a statement that they expect to begin another series of interest rate cuts in 2024. The policymakers hinted at the possibility of multiple rate cuts next year, assuming that the economy continues to slow. The FOMC acknowledged that inflation has eased over the past year but remains elevated and said it would watch the economy to see if any additional rate hikes are needed. That indicates that many officials believe that further tightening will not be necessary. New quarterly economic projections laid out after the meeting show that a majority of Fed officials who participated in the meeting expect rates to fall to 4.6% by the end of 2024. Since they usually adjust interest rates by a quarter point each time, this implies that they will lower interest rates at least 3 times in 2024, and that they are contemplating additional interest rate cuts in 2025 and 2026. This also implies that they are expecting a soft landing in the economy, without plunging the country into recession. The FOMC were quick to pat themselves on the back. In a news conference following the news release, Chairman Powell lauded the FOMC for their work. Inflation has eased from its highs, and this has come without a significant increase in unemployment. That's very good news. We added the word any as an acknowledgement that we are likely at or near the peak rate for this cycle. But participants also didn't want to take the possibility of further hikes off the table. Chairman Powell also said that the unique economic conditions created by the COVID-19 pandemic have helped the central bank's effort to bring down inflation without causing a recession, a rare feat in economic history. This inflation was not the classic demand overload, pot-boiling over kind of inflation that we think about. It was a combination of very strong demand without question and unusual supply-side restrictions, both on the goods side but also on the labor side, because we had a labor force participation shock. The Fed has viewed its inflation fight as a two-front battle of trying to weaken the demand in the economy while the vertical supply curve normalized, Powell said. The supply side of various parts of the economy is now getting closer to where it was pre-pandemic, he said. Something like that has happened so far. The question is, once that part of it runs out, and we think it has a ways to run, at some point you will run out of supply side help, and then it gets down to demand and it gets harder. That's very possible, but to say with certainty that the last mile is going to be different, I'd be reluctant to say we have any certainty around that. So far, so good, although we kind of assume it will get harder from here, he added. Powell spoke as if the virulent inflation that the United States has been experiencing is a force of nature. Inflation just happened to the economy. Actually, that is not correct. It didn't just happen. Inflation is not a natural occurrence. It is caused by the reckless and irresponsible policies of the central bank. Federal Reserve policies are the cause of inflation. The measures to rein in inflation were efforts to cure an affliction that was released into America's economic system by the Federal Reserve. What was especially disappointing about Powell's remarks was that the Federal Reserve accepts no responsibility for causing inflation. Furthermore, they are announcing that beginning next year they have every intention to begin a new cycle of reducing interest rates, expanding monetary aggregates, and a return to elevated levels of inflation. It was also disappointing that here was nothing in his remarks about the effect of an astronomical national debt on the economic health of the economy. The national debt now exceeds $33 trillion, and the debt service on the national debt now exceeds $1 trillion annually. In his remarks, he did not mention that the standard of living of Americans has been in decline. The enormous national debt and annual budget deficits have been gradually eroding the quality of life for Americans since the 1960s. Powell has maintained over the past year and a half that it was still possible, though not necessarily likely, that the U.S. economy could achieve a soft landing, where inflation returns to the Fed's 2% target without causing a significant rise in unemployment. If this explanation of Fed policy sounds vague, there is a reason for that. It is deliberately vague. Their description of the economy is similar to the way in which Powell and other Fed members described inflation in 2021, sometimes saying that the rapid price increases would prove to be transitory. A few weeks later, they were forced to reverse themselves and accept that inflation was accelerating. Inflation then spiked to a 40-year high in mid-2022. The Fed then began aggressively hiking interest rates in March 2022. The Fed hiked its benchmark rate more than 5 percentage points in total since then. In truth, they have no idea whether their efforts to stem inflation or avoid recession will be successful. Thank you for watching. If you would like to see more videos on this subject, give it a thumbs up and don't forget to subscribe. If you leave a message below, I will respond. Remember, always do your research and consult with financial professionals before making investment decisions. The information provided in this video should not be construed or relied on as investment, accounting, legal, or other professional advice under any fact or circumstance. You also might like to check out my pages on Facebook and Rumble, the Global Macro Digest are, and see my books that are featured there.